Kitco News special coverage of the New Orleans Investment Conference is brought to you by Discovery Group.
Hello, this is Kitco News. I'm Michelle Makori, and we are continuing our coverage of the New Orleans Investment Conference and thrilled to welcome back to Kitco none other than Danielle DiMartino Booth, CEO and Chief Strategist for QI Research, and of course, a former Fed insider and a fan favorite here at Kitco. Great to have you back with us.
It's great to see you.
All right, so we'll pick it up where we left off last time, Danielle, and of course we were talking about the Fed last time, and we've just had the FOMC come out and say that they're holding steady for the second time in a row. Jerome Powell, though, indicating that there is still room for another hike. The consensus seems to be that the Fed is done. What say you?
I think the Fed is finished. And I think Powell knows that he's finished, but he still wants to continue shrinking the size of the Fed's balance sheet. And you know, that's a little bit difficult to do if you start broadcasting that you're going to be lowering interest rates. So, you know, the market priced in after the disappointing payrolls report, the first rate cut coming in June instead of July of 2024. But again, I think when he does come out of the gate and start loosening monetary policy, that it's not going to be 75 basis points at a time the way he tightened. I think he's going to try and take baby steps.
Does it matter, though, in terms of the impact that these restrictive conditions are already starting to have on the economy? I mean, we've gone up from zero effectively to 5.25%, 5.5% in about 18 months.
Right.
So
That's a wrecking ball.
even if we pause, or even if in a few months' time he cuts by 25 basis points, sure, the equity markets like it and they cheer on it, but in terms of the fundamental of the economy, well, what's the impact there?
This is the damage has been done. The damage has been done. You see that with, with PIMCO walking away from a portfolio of 10 hotels. They're saying, wait a minute, I thought it was just office that was impaired. I thought that was where the whole story was. Well, no. So you're seeing the divide between where companies originally financed their commercial real estate and the equity that they would have to put up in order to refinance it. The divide is just too big. They're walking away. And that's a 2023 story. In 2024, then you have the narrative bleed into corporate bonds. And they have to refinance in the junk bond market. And that's why we're seeing the bankruptcy cycle take off as much as it is. Companies know that they're not going to be able to go from maybe having a 2% bond to a 5% bond, a coupon. They know that they're going to have to declare bankruptcy instead. And we're seeing that. So the lag effects since March of 2022, when this tightening campaign started, the lag effects are really manifest.
So how do they manifest? When you say the damage has been done, what kind of damage are we looking at?
Lenders are sustaining losses. I mean, when lenders start to sustain losses, when companies start to go out of business, when Rite Aid is declaring bankruptcy and WeWork is declaring bankruptcies, and you're seeing all of these closures of stores all around the country, those are people's jobs. They're real living, breathing people who are losing their incomes. You're seeing this when the CEO of Target comes out and says, American households are buying less food, not trading down from, say, filet mignon to ground beef. They're just buying less. So you're seeing households, you're seeing the default cycle with households. Google searches for how to give away my car. Google searches for I can't pay my credit card bill. They're through the roof. And so you're seeing real stress. You've got a 0.5 percentage point increase in the unemployment rate. Historically speaking, you're already in recession when you cross that Rubicon. We crossed that Rubicon in October. So we're there.
And yet, Danielle, the GDP figures try to tell us otherwise. Now, granted, there are lagging indicators as well, but third quarter GDP coming in at an astounding 4.9%.
And it better have, because the U.S. government gave out $29.8 billion in employee retention credit proceeds in the month of July alone. So how on earth could we possibly see consumption crimped until QI Research, the research that we did on the employee retention credit, on the fraud, on the government giving out $470 some odd billion and $757 billion in Paycheck Protection Plan loan proceeds that were forgiven. This is pretty easy to prevent a recession with $1.2 trillion of extra spending. And that's exactly what U.S. taxpayers paid for. But that gravy train is pulled out of the station.
So when does the pain, not that we're looking forward to it at all, but when does the pain really, really, really hit, and what does that look like?
So we're seeing it, whether you're talking about airfares beginning to come down because I was on an empty flight. I looked back at an airplane a few days ago and didn't see anybody. So the last time you were on an empty flight, but you're seeing it and you're hearing the CEOs say, you're hearing this one CEO during the current earnings season after another is saying, we were expecting a recovery in demand by now. Where is it? And the destocking has continued. We're in a manufacturing recession. You had car supply increase in the middle of a 6-week strike by the United Auto Workers. And you had your days supply increase. That's how quickly demand for vehicles, big ticket items, discretionary goods, that's how quickly demand is crashing.
So what is your macro outlook then in terms of what we can expect 2024?
Well, I mean, typically, again, once you have a 0.5 percentage point increase in your unemployment rate, you are in recession. So I think recession base case started in the current quarter, just given where the unemployment rate is. And we won't have any, the debt's going up, the deficit's going up, the Inflation Reduction Act. All of that money is certainly in the economy, but we won't have fresh stimulus spending until after Election Day, which is in another year. And you won't get anything passed until there's a new Congress because this dysfunctional House of Representatives that could not get a speaker is not going to be writing any fresh stimulus checks to bail out the Biden administration.
Well,
not happening.
Speaking of dysfunction, how likely do you think it'll be that we'll get a government shutdown come November 17th?
I think that the market is underpricing that risk. I really do. There haven't been any of the concessions that those on the far right have been demanding. So all these months later, after the debt ceiling was resolved, they're still not getting what they want. And they've already shown us that they're willing to drive activity in Washington, D.C. just to a standstill. They've demonstrated that. So why wouldn't they shut the government down?
What would that look like if we do have a failure to reach another budget and kick the can down the road, which is what they did last time? What would that look like in terms of government shutdown? What kind of market response? What kind of dollar response, given the credit of the U.S. dollar has been downgraded by the ratings agency? What do you expect to happen if that is the reality November 17th?
The good news in air quotes is that Germany's in worse shape. Europe is in a deeper recession than we are. They're already technically in recession. We heard that this last week. Obviously, China's the slowest growth in 40 years now. So in terms of the dollar being kind of dispensed with, that's not going to happen. But what you will have is food banks that are very busy. Government workers, when they're furloughed, don't get paid. They get back pay when the government opens back up, but they don't get paid while they're being furloughed. And that's going to be a big problem. I don't think we have a deep enough appreciation for how very damaging the current holiday shopping season can be. And that's why we're seeing, again, bankruptcies one after another after another. A buddy of mine runs dailyjobcuts.com. He reached out to me a few days ago and said, Danielle, it's November. This is when, seasonally speaking, we see companies stop closing. It accelerated. What does that mean? Companies know they're not going to make it through the holidays.
Last time you were on, Danielle, you said that you personally had zero exposure to the equity markets in your personal portfolio.
I now own a Brazilian food company. I'm happy to report. Great dividend.
So you're back into the equity market. And
I'm back into one stock that pays a nice big fat dividend, bigger than a T-bill, sure.
So just one stock that you're exposed to personally now. And that is a Brazilian food company?
With a nice dividend.
And what is that company?
Oh, I can't even think of what it is. I truly can't remember the name of the company.
All right.
I just know that it pays about 7.5%, which is, that's a nice pickup off your T-bill yield.
Well, since then, that was about 3 months ago, the S&P is up 13.5%. So arguably, you personally missed out on that upside.
Sure. Okay.
No, not a concern. You're still maintaining that.
No, I'm
it's
still
a
teaching.
good time to be
My children are like, you're not kidding about this compound interest thing, Mom. It's real. And I'm like, yeah, it's real. So we're all enjoying the 5.5%. Look, we had a 10% correction in the blink of an eye in the S&P 500. And so we know that there's downside risk. We know that there's no fiscal stimulus out there. We know that CEOs are telling us that their businesses are hurting. So we're going to stay in an earnings recession.
And you anticipate that to start being reflected in the equity markets?
Well, I mean, equity markets are all about liquidity, right? You've had Bitcoin go on a flyer. And so you've seen liquidity flow back into the stock market. But is it going to be resilient in a real recession? Not an earnings recession. We have one of those. Not an industrial recession. We have one of those. But we now have a 3.9% unemployment rate off of 3.4%. So does the stock market rise in a real recession? Not last time I checked, but it could be different this time. You never know.
So given that, what is your portfolio positioning? Not your personal portfolio. What is the...
Look, we're advising our clients that in the sense that they need to own credit. They want strong balance sheets. They want cash flow. They want companies that are going to be able to ride the storm, not companies that are going to be cutting their dividend. Strong cash flow companies, rock solid balance sheets. Banks are still impaired. Commercial real estate's still a train wreck. So in terms of hard assets, it's really hard to invest yet until you start to see more transactions occur as the WeWork bankruptcy filing expedites what is normally a very slow glacial process to play out. Commercial real estate cycles play out over a number of years. But if you have a great big name and 90 million square feet around the world, all of a sudden, say, we're filing, you're going to start seeing more transactions. And that means that distressed investing is going to come back in vogue. So people who have dry powder and they're able to get some of these fire sale prices, they'll do fabulously. People who are levered and need to borrow in an environment where you're seeing lending standards continue to tighten, we'll see more evidence of that with Monday's release of the Federal Reserve Senior Loan Officer Survey. But in an environment where lending standards continue to tighten, you better not be a borrower. But if you've got cash, you can get some good prices.
Well, last time you were on, you also said that you expected more bank failures to happen. Mm-hmm. What is your outlook then on the banking sector? Jerome Powell tried to tell us the other day that it's sound and resilient.
Of course, that's his job.
What do you think we can expect in terms of regional banks as this starts to really filter through?
And that's your real, Michelle, that's your real pain point there, is those regionals that have this huge exposure to commercial real estate. We already know that they're sitting on losses in their treasuries and in their mortgage-backed securities. They're already sitting on those losses. Beyond that, though, the collateral backing these commercial real estate loans is garbage. And so that really is going to be the next step, if you will, for the banks. They won't be able to escape it. The FDIC is having a hard time brokering marriages in this kind of an environment, though, because one bank can't buy another bank because then you've got to buy all those losses. So they say, may we live in interesting times. It's really getting interesting.
That's a Chinese curse, by the way, and it's a curse. May you live in
interesting times. And we are, and like I said, if the commercial real estate cycle accelerates into 2024, as the corporate bond market has to refinance, junk bonds refinance, we're not over the worst yet, not yet.
And I haven't even touched on the geopolitical issues and the impact that they could have.
I mean,
with Middle East tensions escalating.
I think U.S. political is going to be much more disruptive in 2024. I think this election year is going to be more harmful potentially, and certainly make markets more volatile than anything that's going on overseas. As tragic as the issues of the day are, I don't deny them, and I don't try and belittle them either. But what's going to happen here, front and center, domestically in the United States of America, in this election year is going to get ugly.
When you say more harmful, elaborate on what you mean by that. More harmful to the economy.
Again, we're in recession, and we have a dysfunctional Congress. We don't have any candidates who should be candidates of the world's largest economy. And that's going to be reflected in markets.
Is there any scenario that derails what you're saying, that changes things, that flips things around? Is there any?
I think if we get two good, viable presidential candidates who understand economics, that would really inject a lot of hope into a country that really needs a source of hope right now. So I think if we get to a situation where we're not going to be like, we're going to be fighting like cats and dogs into election day, if we can change that, if we can come up with, and you know what, and the billionaires are talking about it. The billionaires, they're talking about backing rational individuals. I'm not going to name any names, but the billionaires are finally talking about backing rational individuals who actually love this country enough to try and save its economy. And that will change the narrative, and that would make me very optimistic.
Are there any two candidates that you think, should they be the candidates on either side, could inject some hope?
I do.
And am I going to get you to tell us who you think they are on either side of the aisle without picking a winner?
It's certainly not Gavin Newsom.
Okay.
We don't need more socialism.
Well,
and I think that the risk is that millennials outnumber any other voting cohort in America. I think that they enjoyed not paying their rent. I think that they enjoyed getting paid to not work. And I think that they want more of that. And your bigger risk on election day is that you get a massive progressive wave and you bring back universal basic income, modern monetary theory, everything that ignited that awful inflation that was pushing into the 10% area. I think the biggest voting bloc in America wants to bring that back.
Do you think that there are any candidates currently running on the Republican side that, should they become the winner of the primary, could inject that hope from the current candidates?
Yes, I do. And she's a rock star.
So that would have to be Nikki Haley then.
I didn't say any names.
Well, judging by my assessment of the candidates, I believe we've only got Nikki Haley.
You've got good judgment then.
A female front
I'm
runner.
happy to hear you endorse her.
So I never said I'm going to stay neutral on that, but I never said I did endorse. I never said I didn't endorse her. But you are saying that if Nikki Haley potentially comes through, that could be enough of a hope infusion to.
There's not even any gray area. She's outright won 2 debates in a row. I'm just saying, the country needs a winner.
And that would be enough to inject hope, but it doesn't change the damage that's been done in the past.
No, it doesn't. It doesn't take us out of recession either. We have to get past this. The business cycle has not been eradicated. But I don't foresee any kind of stimulus saving this economy from recession.
Well, that's what got us into this mess in the first place. I mean,
Absolutely,
arguably, stimulus is not what we need.
I couldn't agree more. But there's nothing that's going to make recession hurt less in the near term coming out of Washington, D.C.
All right, so we have to swallow the bitter medicine. But you're saying that depending on...
But think of all the zombie companies we're getting rid of, finally. Amen.
I mean, sometimes it's necessary to, burn things down for the green sprouts to come up,
and then
right?
you come up, and then you, in the wake of all that, you get an incredibly innovative, good business model companies who are creating jobs. Great.
And you think that Nikki Haley may have the economic...
I didn't say any names. I just simply said that there are some rational sounding people out there who happen to be winning debates.
Okay. And on the Democratic side, I mean, we've only got officially Biden and...
Yeah, I mean, I don't...
And the other challenger, whose name I can't even remember because he hasn't even made a dent.
No, but the rumor mill is Gavin Newsom, and that means socialism.
The rumor mill is Gavin Newsom and potentially even Michelle Obama is what the rumor mills are churning out. So that...
We don't need more socialism in America. I think that we've come through this inflationary train wreck, and we don't need to bring more of it back.
All right. Very, very quickly back to gold and silver. Another candidate, Vivek Ramaswamy, at some point said that he would consider backing the U.S. dollar with hard assets, including gold and silver.
It sure does sound like a good talking point for a politician.
It does not.
It sounds like a good talking point for a politician.
Right. We don't know how feasible that will be.
Yeah. Has anybody actually asked him how he's going to manage to do that?
He said he would look at backing it with a basket of commodities in light of the fact that there was speculation that the BRICS would be coming out with a similar play.
And how's that working out for the BRICS?
Well, they haven't done that yet.
Yeah, they haven't. And Saudi Arabia continues to issue its own sovereign debt in dollars, as tough as it's talking.
So... not a move that you're advocating for, but
all I'm saying is it's fun to have talking points. It's great to be sexy and tweet it out. But in terms of being practicable, I want somebody who's going to tell me what they can get done, not what they could get done in an ideal world.
So talk to me about
that's why we have Santa Claus.
So, all right. So are you hoping for Santa Claus to put gold coins and gold bars in your stocking this season? What is your position?
Gold bars love recession. I mean, gold loves recession. What does gold love more than recession? A global recession. What does gold love more than a global recession? World trade contracting. So gold's in a happy place right now.
And are you increasing allocations to gold and silver?
No, my allocation is where it is, and I've always been. I don't think you should. I mean, I do believe in the powers of diversification.
And that's you sticking with, I believe, your traditional 10% or 5%?
10%.
10% to gold and silver.
But think about what happens if gold just goes up 2-3% from here. Pretty happy day.
So 10% sticking with gold and silver, and you'd welcome some of that under your Christmas tree. And you may or may not be endorsing Nikki Haley.
All I said is that there have been people who have won debates.
All right. Well, I know we're out of time with you, but thank you so much. Always a pleasure chatting with you, Danielle DiMartino Booth. Appreciate it.
Thank you for having me, Michelle.
All right. Thanks.
Kitco News special coverage of the New Orleans Investment Conference is brought to you by Discovery Group.